Hello and welcome to NDTV Profit. I'm here actually in Alua, which is very close to Kochi, right next to the airport actually. And we are here at Federal Bank's head office. And I have with me the pleasure of talking to Mr. KVS Manian, the MD and CEO of Federal Bank. I wanted to call you a newly minted, but then I realized from your team that it's been a year.
Almost.
I not quite realized that it's been a year now. But I just wanted to, start this conversation off with a slightly...
Thanks, Rishi. Thanks for coming.
Thank you so much for having us, sir. I just want to start this conversation off with a very simple, easy question because I have come to this room to interview your predecessor. At that time, there was a very prominent Rahul Dravid back that he did not want to move.
Right.
And I was in your conference room a little earlier and I saw there's a Sachin Tendulkar back now. I'm just trying to understand, one of the core ideologies of Federal Bank was to be a staid, very competent, very yes, regional, but also national sort of a bank, right? How are you viewing Federal Bank now that you've taken over, now that you're running things at the bank? How are you viewing the future?
I would say that my stint is taking forward the journey that the bank had commenced a few years back. I think under my predecessor, Shyam, he did try to take the bank relatively more national than it was when compared to when he joined. And I think that journey is not yet complete. That journey is still half done. And we need to do more of that for sure. So the way I look at it is, it's Federal Bank is a unique franchise in that sense. If you see, there are very strong points in the franchise. For example, if I take you through some of the uniqueness of this franchise, there is no bank which can claim, other than if you keep SBI aside, there is no bank which can claim any territory where they have 18-20% market share in deposits, right? No bank can claim in India. Federal can claim that for Kerala as a state, right? And Kerala is not a small state, it is a medium-sized state in the country. On non-resident, I think there is a significant franchise that the bank has, easily among the best franchises in India for non-resident. In fact, even the inward remittances, we hold almost 20% market share in inward remittances. Federal Bank is the largest gold loan bank, private bank in India. If I keep the PSUs aside, among the private sector banks, it is the largest gold loan bank. Also, the franchise is not built on rates as a proposition, pricing as a proposition. The CaSa franchise, the term deposit franchise, the liability franchise largely is built on a solid footing of the brand being accepted for its service, for what it delivers, and relationships and things like that, and not price driven, right? So these are significant strengths of the bank as I come into the this. So the way I look at my role here is leverage these, build on these further, but also leverage this to take it beyond Kerala.
Sure.
We have dominating market share in Kerala. We need to build relevant market shares outside Kerala, in other states, right? So that's the journey. I think, so I would say it's a continuum, and I have to build on various things. There are also many more things to do. So that's again the beauty of the franchise. It is strong in many ways, and there are many more things to do. For example, I think our small business current account franchise is not as strong as what it should be. Or our wealth franchise is not as big as it should be, or our trade and forex kind of offerings are not what they should be. So I see a great opportunity where the strengths can be leveraged and new things can be done to take the brand to newer heights.
Okay. February this year, you announced the Federal Bank 4.0 strategy to the analysts, right? And in that, you had some very aggressive sort of plans for the next 5 years as to where the bank should be, will be. I'm trying to understand from you what were some of the key areas that you thought would happen a little later, but maybe happen sooner. Maybe like, for example, the fact that you've broken into the top 6 when you were 9th earlier, right? So what else has happened under this 4.0 strategy?
So I wouldn't call that aggressive. The strategy, yes, there is stretch in it and there is ambition in it. Yes. So I would call it ambitious or with a stretch and not aggressive.
Sure.
Because why I use that carefully, because by aggressive you might get an thought process that we are going to take on more risks and do more aggressive lending and things like that. That's not. If you see the plan, it is not based on that.
Yes.
It is based on a clear. So if I oversimplify that plan, it has three key elements to it. One is building the CaSa franchise stronger, especially Ka, and Sa, maybe take it the upper end of Sa, focus on upper end of Sa, because we have a good franchise on Sa. If you look at our overall CaSa of about 30%, we were 24/6. In fact, 6 is already 7 today.
Okay.
Right, in current account. So I think one important thing is to build the CaSa franchise and of course the deposit franchise overall. So the idea was to, first pillar of that strategy was that. Second pillar of that strategy was what I called the middle yielding assets. Improve the mix of the assets. We were far too weighted on the asset side on corporate and home loan as products. Almost 45% of our balance sheet was focused on these two segments, and that meant our NIMs were generally always under pressure because those are relatively lower yield products. So we needed to change the mix on the asset side, and when we change the mix, it is not, we are not getting into I also said that we don't want to do very high yielding assets, 15-20% of the balance sheet, and therefore get the yields up and therefore build a barbell kind of a strategy. We don't want to do that.
Okay.
So what I said is, let us focus on the middle yielding assets where marginal uptick. For example, we were doing home loans. Can we do a bit more of LAP? We were doing commercial vehicles. Can we do a bit more of used commercial vehicles? So things which are not significant change in risk parameter, because there is a DNA of the firm which is relatively well risk. I won't say risk averse. It has a certain appetite for risk. I don't want to dramatically move that appetite up. I want to operate broadly within that. Maybe a marginal uptick to that, where the risk return trade-offs are better. Move it inch it up a bit. More the risk appetite. So that's the strategy. That's why I was saying not aggressive, right? So on the asset side, marginal improvement in the mix will also give us some important uptick in the performance of the bank. That is the second. And third key pillar of that strategy was how to enhance our fee to assets ratio. And fee broadly, we are focused on cards as a business is a fee-oriented business, and therefore we want to grow our card business. I mentioned a while back about the wealth proposition.
Yes.
Our wealth proposition has relatively been not exploited that much. Just to give you a sense, on NR, we have 90,000 crores of banking AUM of NRs, right? Their CaSa and term deposits with us.
Yes.
But we have very little of their wealth AUM. We do not have a strong enough offering on that side. So I see that as a big upside. And then, of course, we also said that we want to focus the bank into small businesses, and therefore products like cash management, trade, forex, these are important. So build fees through these. So these are the three key pillars of the strategy, the February strategy that we are making good progress on all of them. If you look at the last 2 quarters, our CA has progressed. Our CA from 6 has already moved to 7. I had said we want to be at 10 in the medium term. So we are making good progress on CA. On the mix of the assets, there is clearly visible. Our documents that we publish give you clear indication that our mix is beginning to change, and our fee performance has been quite strong in the last quarter. Again, if you look at our fee performance, it has been quite strong. So there is visible impact of some of these initiatives that is showing. Of course, we have just begun the journey. It's a medium-term journey. It's not a so we want to position the bank to a place in the next 3 to 5 years, at a place where it can be top 5 in many parameters. Of course, like you said, we are 6th in the size of business now, asset liability together.
Sure.
6th to 5th is still a long journey, but more importantly, I think it's not about the number 5th or 6th. It is about how we can improve the quality of earnings, how we can improve the presence, how we can improve the brand presence across the country, make it relatively more nationally acceptable brand. All those qualitative things go into that journey. When we say fifth is just a kind of a pole there to watch out for. Yes.
I wanted to ask you a bit about what the future course of business looks like. When you're talking about cost optimization, that was something that was core to your plan. I'm trying to understand, what does cost optimization look like for a private bank that is functioning in 2025, is looking at a slightly more ambitious, as you said, plan to grow, because one would expect cost is part of ambition.
Yes. So, it's interesting you call out cost optimization. But, the way we have looked at it is, yes, we need cost optimization, but I have not built in any benefits out of cost to income over the next 3 years. That is not my key criteria to grow. While we'll optimize costs, we will reinvest during this period and probably keep the cost to income around the levels that we have today. There is a reason for that, because my belief is that there are enough revenue levers that we can pull, which can improve the cost to income, and therefore we will do that. And as we grow the franchise in, let's say, metro cities, for example, our metro penetration is lower than what I would like it to be. So if we add metro network, it's costly, right? But I have to therefore add costs. So the way I am looking at it, we'll have to play a very calibrated game where we build upsides in revenues and therefore build costs according to that, so that we can overall keep the cost to income where it is broadly, give or take, but broadly at the same place. If benefit comes, it is bonus. But right now I have not baked in benefits out of cost to income ratio, while we will cost optimize. Now, coming to cost optimization, there are multiple ways we can do that. For example, I believe that our branch operating model, we are already in a journey where we are trying to change the branch operating model from being overly branch centric to centralizing or regionalizing some of the activities and leaving the branch to do more sales, customer engagement and service. Right? So I want the branches to do only 3 things: acquire new customers, engage existing customers, and serve customers wherever branch service is required. Today we do a lot of other work at the branch. So we are already on a journey where we are trying to take out some of those operational activities out of the branches, and I believe this will lead to cost optimizations in the medium term, right? Because you will make them more efficient as you centralize. You will do it at lower cost. Branches are the most expensive real estate you are sitting on. Your staff at the back end can be lower cost. All the operating costs are lower when you centralize, right? So I think there are cost optimizations possible by changing operating models on many businesses, particularly branch banking and many other businesses as well. So we will optimize costs, but we are not saying that we will dramatically reduce cost to income ratio, at least in the next 2 to 3 year time frame.
I'm glad you brought up the branch point. I want to come to that, but before that, the cost also has a net interest margin impact. I'm just trying to understand, Q1 you've dropped below 3%. Understandable across the industry. It has happened to all banks because of the monetary policy stance at this point in time. How are you planning to push it up, considering that monetary policy itself is very uncertain in the current global framework?
Right. So, of course, our base case just now is no rate cuts from here. But who knows? I know several polls are 50-50 on that. But I am in the camp, let's say, so let's start with the assumption that there is no further base cut, and we have seen for at least next 12 to 18 months more stable interest rate policy, let's say. If that is the case, I think we have a T+1 repo rate adjustment to our loans. We drop the rates the day after the repo rate changes. Some banks go up to 90 days, right? Banks go up to 90 days to change it. So in that sense, we take an accelerated hit at the when it is downward. So in that sense, last quarter we took an accelerated impact of a repo rate cut. So we expect the balanced impact on repo rate cut to be much lesser in the second quarter. So we think we are close to the bottom. maybe we have guided 5 to 10 basis points further drop in NIMs, but not more than that. So we think we are close to the bottom, and from here we can grow. And all the three initiatives, at least two of the three initiatives I talked about, three pillars that I talked about, two of the three pillars are NIM enhancing, right? As we grow our CASA and the proportion of CA more, it is NIM accretive, so we will add NIM. And as I move to medium yield assets from lower yield assets, it improves the yield on the assets, and therefore again it is NIM accretive. So the two are designed to be NIM accretive over a period of time, and that's the plan. So we believe that, like I said, we are already seeing signs of execution resulting in those changes, but we have to do it consistently over the next several quarters to really see the upside in NIM happen. As you also know, we will get benefits as we go forward on the savings rate cut that we made in June, right?
Yeah.
That impact was not baked into the last quarter. So that impact will flow into the second quarter. That's the reason I said that some benefits will come out of our costs as well. And we have dropped our term deposit rates as well. So we have managed costs quite well. Even in the last quarter, if you notice, we have managed our cost of funds reasonably in an agile manner. We will continue to do that, and we hope to get the NIMs back to the 3+ levels and 310, 320. The trajectory will start following.
Okay. Branch banking, I wanted to talk about that. You called it free the branch. I'm just trying to understand from you, what is free the branch for Federal Bank? Because I read the presentation where you talked about how the branches are structured right now and the kind of changes that you want to bring in. But just for our viewers to make them understand, what exactly do you mean by that?
Right. So like I said a while back, our model was a branch-centric model where branch used to do a lot of activities which otherwise can be centralized or regionalized. For example, a car loan disbursement, should the branch be making, or a central or regional setup can disburse, right? Should the mortgages be created by the branch, or you can have a mortgage center of excellence which can take care of that. So there are lots of such activities where we feel our branches are doing a lot of things, and like I said, branch is the most expensive real estate that banks own, right? And therefore efficiency of that premise is very important, and all our front office people sit in the branch. So branch ideally should be a storefront which focuses on getting new customers, cross-selling to existing customers, and whatever little service cash transactions that have to be done at the branch. And unless they have to be done at the branch, we should not be doing them at the branch, because we should give the frontline teams enough time to acquire new customers and cross-sell to existing customers. So the free the branch is meant as an initiative to do that. So when we did our time and motion studies for our branch, we found that the branches are spending very low percentage of their time on sales and cross sales.
Got it.
And we needed to increase that. So we have already embarked on a model where we are trying to move. So we are following all the aspects of that. There are activities which can be eliminated. There are activities which can be moved digital. There can be activities which can be moved to central. There can be activities which can be made more efficient. We can change the process. So it's a combination of multiple things. It's a large project. Of course, it will span over a year or year and a half to get to where we want to. But we are already on that journey, and I believe that this will make our branches available to customers, the branches, time available to acquire new customers, all of that. I think the brand will benefit from such a process.
I've got 3 questions now. The first one is about the way you're talking about the mid-yielding assets, right? I mean, except credit cards, which is the only high-yield product that you specifically pointed out.
Yes.
I'm trying to understand, does it bode well for ambition to have a mid-yielding ambition? Or do you think that maybe for now you move from the low yielding to the mid, and then eventually you would look at the faster yielding or higher yielding products?
No, so the way I look at high yield is we are currently about 4% of our assets are in what we can call high yield, which is essentially 3 products: microfinance, personal loans and credit cards are the three products. You might already have noticed that we are already growing our credit cards business quite fast,
Yes.
right? And in fact, the book is showing that it is one of the faster growing. It's small in base. We are still early players in that. But interestingly, in the last quarter, if you had looked at the net card issued, we ranked fourth in that in the new cards issued.
Yes.
So we are trying to, of course, that's because our cancelled cards are very low. Our base is small, so I'm not as much on the fourth rank. It's not important, but basically we want to grow.
It's an upward momentum that you want to focus on,
and that will add high yield asset. On personal loans, again, I think we are comfortable now with the asset quality or the cycle that we have seen. We do want to grow that faster. MFI is one where I would wait for a quarter or two to get better comfort before I start growing. But having said all that, from our current 4% over a midterm, can we be in the late single digit 8-9%? Maybe yes, and that will add NIM to us. But I am not a big fan, as I told you, of building a barbell strategy where you build 20% of your assets in high yield. That's not my intended strategy. Yes, we need high yielding assets, but we would like to keep it in the sub 10%, which gives us some uptick on the NIM, but doesn't add too much risk to the book and volatility to our earnings. Because these high yield assets also add high volatility to your earnings, and so the proportion is very critical. And so I would say we will follow that. Like they say, खाने में थोड़ा अचार अच्छा है, but अचार के साथ खाना नहीं. So I think high yield assets are the achars.
Okay, let me also bring to my second question, which is about your NR strategy, the non-resident cohort of the customers. I mean, Federal Bank is widely recognized as a non-resident focused bank. Of course, the Gulf countries are your primary source of the NR remittances, but US is also a large participant.
Yes.
In the current environment where the US political landscape is toward penalizing any money going out of the US, especially remittances, they levied 2.5%, if I'm not wrong, tax on that.
It's not yet levied. I think it's a proposal. Yeah, it's a proposal.
I'm trying to understand, does that hurt you, or is that something that you're like, okay, this is part of business, we'll see what other geographies we can grow in?
Yeah. No, so I think some of these keep happening with business. Some geography goes out of action sometimes. So I think we'll have to just ride this. To give you a sense, of course, we have a very strong presence in the Middle East, and even in Middle East, there are countries where we can grow.
Yeah.
Right. Even in Middle East, there is opportunity to grow. That is one. Second, I think also the nature of non-residents business is also changing. Good old days, the large part of NR was focused on either the Middle East or US, but of late we are seeing it diversify into many other European states, Canada, Australia, New Zealand. So I think the NR characteristics of that market is also changing. So I think there is enough opportunity in. We will of course remain focused on US. US is a good market, and hopefully this. Let's see how this pans out. This proposal, whether it gets applied or not. But I think even if US is our second largest territory after GCC, so will US grow lesser if this were to come true? Probably yes. But I think there are enough markets to grow. And last year we have seen NR grow very well and grow well across the geographies. Interestingly, we also have a different opportunity. We also have an opportunity as Federal Bank. We were always good at GCC, of course, but also we were strong in Kerala, right? Non-Kerala GCC is also an opportunity for us, right?
Okay.
So I think there are enough opportunities to offset some setbacks that can happen in some markets. So we remain optimistic about our growth in the NR business.
Final question is around the liabilities portfolio, for the sector as such. I wanted to get a sense from you. Some of the private banks out there are sharply hiking the minimum average balance, because they believe that that's the way to A, retain a higher CASA ratio, but also B, to better cross-sell products, because you want high-value partnerships with your customers. Previously, bankers have pointed out that the nature of CASA has changed entirely. People are no longer interested in keeping money in their savings account for very long, because there are high-yielding products now. If it's not the bank, they will go to the market and they'll make the money there. I am trying to understand from you, where do you stand in this camp? Are you somebody who believes that I need to retain maximum relationship with the customer, so I want your high value customer base only? Or do you think that banks are an essential service and let people keep money however they want to keep?
So just first to address the macro on the deposit side, one of the beliefs I have is there are three parts to the deposit, right? CASA and term deposit. I think it is a term deposit which is an investment product.
Yes.
CA and SA are transactional products. Yes. So yes, term deposit will face competition from other wealth products. I understand that. I do not agree that CA and SA are competition from wealth products, because they are transactional. In fact, if a customer trades in the stock market, his SA is better.
Correct.
Than a customer who does not, because transactions lead to CA and SA balances.
Better balances.
So I don't see a conflict with CASA, right? So term deposit, yes, but there my view is that as India, if India story has to play out in the next 10, 20, 30 years, then our $2,000 per capita hopefully has to go towards $10,000. So deposit will remain a product, and there is it is a the person who first buys financial products.
Early introduction.
It's an early introductory product, right? So as people rise from this 2,000 to 10,000, I think there is a humongous opportunity.
Right.
And, a small percentage of that 10,000, a smaller percentage of 10,000 will be bigger than a bigger percentage of the 2,000.
Sure.
Right? So I do believe that deposit will grow, may not grow at rates that are 15 and 20 or mid-teens and all that. But I think early double digits, it will continue to grow. So we have to remain there. And we as a small share of the market, I think we have to find our strategies to continue to grow rest market share. On CA and SA, I do believe that, of course, there the pressure is coming out of efficiency of the system, right? System is getting more efficient, payment systems are better, and that's what leads to lower CASA, right? Pressure on CASA, not the investment product.
Got it.
So there, I think, like I said, for example, for us, if we focus on wealth and wealth products, which I said is a means to get fee, it also enhances our SA. Right, so I don't see a conflict with these, and we have to continue to do. So, for example, our corporate CA is quite low, and we have an upside opportunity because we just launched our cash management system last month. Right, new cash management system was launched last month. So we have to create products. Cash management, online trade, and things like that, which we will create to get a CA. Coming to your minimum balance question, see, I think every bank to their own on the strategy of what they want to achieve. And all I would say is at our stage of growth and where we want to see, I think we have to play the mass affluent category, and we have said mass affluent is our focus area, and we will do products which continue to sell for mass affluent.
Even your wealth products.
Even our wealth product will be focused. Even our wealth strategy is not going to be private bank based strategy initially. We want to be focused on the mass affluent segment, and that's what our focus will be. And so we will continue to do products which are suitable for that.
All right. Mr. Manian, thank you so much for joining us on this conversation.
It was such a pleasure talking.
Such a pleasure talking to you as well.
Thank you.
Thank you.
Thank you.